President Trump recently removed the head of the Bureau of Labor Statistics following a revised jobs report showing a sharp drop in employment. That decision raised serious concerns about the independence and credibility of U.S. economic data. And here's the reality: when trust in these institutions is shaken, it's not just a political headline. It can change how global markets view the entire U.S. economy. Think about it. When investors lose faith in the accuracy of official numbers, whether it's jobs, inflation, GDP, or corporate earnings guidance, they adjust their strategies. They demand a higher return for taking on U.S. risk. That can mean higher yields in bonds, more volatility in stocks, and even shifts in currency valuations. You can already see the ripple effects. In bond markets, Treasuries may start to carry a higher risk premium, and inflation-linked securities lose some of their reliability if the inflation data itself is in doubt. In the stock markets, without solid macroeconomic data, equity analysts can't forecast earnings with as much accuracy. That uncertainty leads to wider price swings and more volatility. Currencies feel it too. If global investors begin to believe the US dollar is no longer the safest bet, they'll start moving into other currencies they see as more stable. And in real estate and alternative assets, when rates move unpredictably, financing costs can shift quickly, pushing investors toward assets with more tangible or global pricing benchmarks, things like commodities or foreign real estate. Already, Reuters, Barron's, and Nuveen have reported that recent trading this week shows Treasury yields falling sharply, with the 10-year dropping into the low 4.2% range and shorter maturities also sliding, as markets respond to weaker jobs data and political uncertainty. Political risk is now sitting right alongside longstanding concerns like federal deficits, tariffs, and global economic slowdowns. For decades, the U.S. has been the gold standard for transparent, accurate data. That's a big reason the U.S. dollar, Treasuries, and U.S. equities have such a dominant place in global portfolios. But when that reputation takes a hit, investors start looking elsewhere, to other countries, to private data providers, or to alternative asset classes altogether. Some economists warn that this is a slippery slope, drawing comparisons to countries like Argentina, where manipulated inflation statistics destroyed investor trust for years. And the thing about trust is, it's much harder to rebuild than it is to lose. The takeaway here is straightforward. When data credibility is in question, the risk premium rises across the entire economy. If central bank independence comes into doubt, volatility goes up, and market guidance becomes harder to believe. In times of uncertainty, investors move toward other safe havens, whether that's foreign government bonds, commodities, or alternative assets. And when interest rate expectations shift, it can change the entire investment landscape, from the cost of borrowing to equity valuations to global capital flows. The bottom line: the trust investors place in U.S. institutions is a cornerstone of how assets are priced, how markets function, and how capital flows worldwide. If that trust is shaken, the effects spread far beyond treasuries, reaching stocks, currencies, real estate, and commodities.